Before we start this video, do like and subscribe to our channel and not miss on any updates.
So now let us pick up the first item for our discussion, and as I told you, we are going to start first with the balance sheet items. So let us pick up the first one, and that is share capital. So we are now going to discuss how are we going to do the audit of share capital. Two important things that you have to understand. First, do not look at the volume or do not look at the content, how much it is in the context of share capital. So when you look into your study material and when you run through the pages or the notes that you have when you run through the pages, you will see audit of share capital, so many aspects to be studied. So it is going to be very difficult, something not possible to be studied, and obviously you'll get carried away with the content and you might think of not doing it. First thing, do not do that. Second, do not try to mug up this particular part. If you try to mug up this chapter, it is not going to serve any purpose to you. The only thing is you need to understand the flow, you need to understand the concept, and then in the exam, automatically looking at the question, you will be able to frame an answer if you know the concept very well. Basically, here mugging up will absolutely not help. In fact, wherever in audit, I would say mugging up will never help because the content is very huge. So you really cannot have the attitude of by-hearting anything. Here also when you look at it, when you look at audit of share capital, when you turn around the pages of the study material, you will see 6 to 7 pages are discussing only what are the audit procedures for verifying a share capital. So in this case, what happens is our mind will get carried away. How are we going to remember? But trust me, all of this is so well interconnected, it is so well interlinked, and the basic understanding is these are not something brand new to you. It is something that you already know, that you study as a part of company accounts, you study as a part of company law, that is Companies Act 2013. So things are going to be very simple. So two things remember, do not get carried away with the volume, the content. Second, do not try to by heart. Only focus on understanding, only focus on imagination, only focus on getting it well structured in your brains, and automatically the answer will flow. With this backdrop, start listening to what we are discussing now, and automatically you'll be able to make a proper answer when the question comes about auditing a share capital. Okay, now whenever you get a question like this, understand full-fledged question will never come up. Like how are you going to audit the share capital? Obviously, share capital is bifurcated into a number of ways. Like we have issue of securities at a premium, issue of securities at discount, issue of sweat equity shares, okay, reduction of share capital. So basically, we are going to study multiple aspects in share capital discussion. So one of it will be picked up and questioned. However, our understanding should be thorough in every aspect. So because of that, everything has to be understood properly. Clear? All right. Now, this entire discussion of audit of share capital, we are going to bifurcate into two parts. First, we are going to do general aspects, and then we will pick up specific parts. General aspects as in, basically we are going to verify certain assertions. So existence of share capital, completeness of share capital, valuation of share capital, is it done appropriately or not? Presentation disclosure, appropriately or not? And apart from that, we also going to have specific discussion regarding certain specific provisions. Like if shares are issued at discount, then what will the auditor verify? If shares are issued at a premium, what we have to verify? If there has been a reduction of share capital during the year, what have we to verify? If there is issue of sweat equity share, what have we to check? If bonus has been issued during the year, what has to be checked? So basically, one is going to be a general aspect and one is going to be specifically pertaining to certain provisions of the company law. So that is going to be an elaborative discussion that we are going to have, and also at the end, something extremely important at this point, and that is going to be the presentation and disclosure requirements, okay, of the share capital as per the Schedule 3, Part 1 of the Companies Act 2013. So that also is important because questions can definitely be picked up on asking you regarding the presentation and disclosure requirement as per the Schedule 3 of the Companies Act. Correct? So with this backdrop of what you require to understand, okay, let us have a quick, first the base, then we'll build up the answer properly, then we'll study all the different aspects, and at one point in time you'll understand, okay, this all is something well structured. And also, if you have already finished studying company law, you have already studied the topic of share capital, this will look very, very simple. Because from there, we simply pick up the provisions and we are going to simply add the word verify, verify, verify. So when you have issue of shares at a premium, then you have already studied section 52 of the Companies Act 2013. So obviously whatever you studied there, the compliance of that we have to check. So whatever we are going to look into for share issued at premium, what is the meaning of it, how it is authorized to the company, how can you use the amount of share premium, okay, all of these things are we want to verify. So answers are going to look very simple. So this is a combination of audit, law and accounts taken together. Alright. Now with this backdrop, let us have a discussion. What we will do is, first I'll give you an entire understanding about this concept of share capital. We'll understand the auditing points and then we will read everything in detail so that the conceptual clarity is 100%. Clear? Alright. So we have audit of balance sheet items beginning with. So we take up the first one, that is share capital. Now you all know that in companies, okay, the very life cycle of the company begins with the raising of the capital. Without money, how are we going to work? Correct? So because of that, understand there are two ways through which money can be issued or money can be raised in the business. One, you go to a bank, borrowings are there, okay? Or second option is by issuing of shares. That is, this ownership, the capital, will get distributed amongst number of people. So distribution of ownership amongst various people or various persons, okay, that is in the form of a share capital. If you leave private companies aside and we discuss particularly about a public company, how does a public company actually issue shares? Now when you talk about a company, okay, now in private companies, you know, it is a very, a closed decision. It is going to be a private placement, but specified people will be decided, offer will be given to them, they have to apply, shares will be allotted to them. But in public companies, when shares are issued to the public in general, then what is the logic or what is the flow, how it happens? The company goes on with the issue of prospectus. This prospectus could be sometimes statement in lieu of prospectus, okay, or it could be a different type of prospectus like shelf prospectus, red herring prospectus. All of these we study as a part of company law. Okay, we have section 31, 32, which discusses all these concepts very clearly. So company goes on with the issue of a prospectus. In the prospectus, all the details will be given regarding the use, why the money is raised, okay, what will be the price, okay, where the money will be utilized. So all the details will be given, like every single detail for the requirement of the fund, utilization of the fund, the company's background, everything will be very properly given in the prospectus. This will be filed with the ROC and then it will go to the public. Now public will rely on this prospectus and then will make an application to the company. So they will start applying to the company shares. When they make an application, along with that they also pay amount which is called as the application money. Correct? Now, company receives the application, so they will receive the application forms along with the application money. Where we have a concept of under subscription, equalized subscriptions that we have, that is equal subscriptions you receive, or over subscription. Correct? Now, in case of under subscription, we obviously cannot move for allotment unless we have a minimum subscription. Okay, if it is equal, then obviously you can go on for allotment. And if it is over subscription, we go for a concept of pro rata allotment. Correct? Where some applicants will be refunded back and the balance applicants will be getting pro rata basis. Like for every 3 you have applied, you'll be allotted 2 shares. So there'll be some criteria based on which the allotment will be done. Correct? Now, obviously in the prospectus, there will be minimum subscription very clearly mentioned. Okay, basically we talk about 90% to be minimum subscription, that is as per the table F. However, company can have it in its prospectus, the minimum subscription. So when this application money and the application forms are received, then company will have to wait for the minimum subscription to be collected. Once the company receives the minimum subscription, then compulsorily within 60 days, the company must allot the securities. And if the company does not allot the securities within the 60 days, then they have to move in for what? Refunding. So refunding should be done to all the applicants. So we don't call them to be shareholders because they're not our shareholders. We call them to be refunding back to the applicants. Within 15 days, you have to refund back all the money, and if you delay, obviously interest will be levied. Correct? So within 60 days from the receipt of application money, you have to go in for the allotment. Correct? And that is how much 60 days timeline given. Okay, now, so when you allot the shares, then there could be a possibility that all the money is not called into the application. So they will bifurcate into 3 stages. Some amount you call in the application, that is already received money. Some will be allotment and then will be call. So company can make 1 call, 2 calls, 3 calls depending upon the requirement. Okay. So application money you already receive with the application forms. Then you make the second call, which is called as the allotment, and then the remaining calls will be made as and when it is required. Correct? Now, so once the company does the allotment of securities, they have to file a return of allotment with whom? MCA, that is ROC. Okay, so they'll fill a form through which a return of allotment will be filed within 30 days of allotment. Mandatory. Correct? Then after that, the company will make the next call, which is considered to be allotment. Then people will pay for it. Then we do accounting entries for it. So accounting has to be done appropriately. Then there comes the concept of next call. So calls also will be made, so amount will be due, and then the people will make the payment of calls. Then you have the concept of calls in advance, and then you have calls in arrears. What is calls in advance? You have made a call, okay, for allotment, but they have also paid you for the first call. So you receive additional amount, advance amount. Now obviously when something is received in advance, that cannot be accounted for as a capital, it has to be shown separately as calls in advance. Correct? It will be a liability, current liability for you. So basically here the presentation and disclosure is very important. It cannot be clubbed with the share capital. The accounting has to be done appropriately, it will be disclosed separately. Similarly, you have calls in arrears. Calls in arrears is, suppose you have made a call, and when you make the call, every shareholder is not paying for it. There are some shareholders, maybe 1 or 2 shareholders, 10 shareholders who have not paid the call as and when it was due. That means their amount is still outstanding, they are still in arrears. So that is called as calls in arrears. Now this also should be adjusted where against the calls, that is the called up capital, and then your paid up capital will be reflected as a figure which is adjusted by minusing the calls in arrears. Clear? So that is the concept of calls in advance and calls in arrears. Correct? So here accounting has to be done properly, presentation and disclosure has to be done appropriately. Calls in advance will not be shown as a share capital, and calls in arrears will be deducted from called up capital. That is, paid up capital will be always an adjusted figure for calls in arrears. Clear? Then after that, you also have to understand that there are different types of capitals in the company, which is going to be authorized capital. These are called classification. Then you have subscribed capital, called up capital, and then you have paid up capital. Correct? Now authorized capital is the capital which is authorized to the company. It is going to be the maximum capital, okay, which the company can raise, correct, during the life of the company. So this will be given where? In the memorandum of association. Obviously understand, does not mean during the life of the company, means it is completely freezed. Obviously we have the concept of alteration of the capital clause of memorandum. So if you follow the procedures given, okay, of how to alter it, then definitely there can be alteration done and the increase in the authorized capital can be done. However, in the very beginning itself, you cannot have this number very high because you have to make the payment of fees to ROC, which will be a percentage of this. And basically, obviously, if we keep a very high number in the very beginning, thinking every time who is going to do the alteration, then the amount that you have to pay to ROC is going to be a percentage of this, which is going to become very dangerous. Correct? So it will be a very calculative number, authorized capital. This you will find out where? In the memorandum of association, where we have a capital clause. Correct? Where this number will be given. And obviously this number will be given with number of shares into face value. And amount will be given very clearly. Correct? Then. And obviously this will be for separate type of share, for equity separate, for preference also separate. Correct? Then. Once you have the authorized capital, out of it, some part will be, sorry, here we missed out one, it's issued capital. Out of authorized capital, some part will get issued to the public. Correct? So once it is issued, then people will subscribe for it. That is called subscribed capital. Then company will make calls, which is nothing but the called up capital. And then the people will pay, that is the shareholders will pay for it. That is called as the paid up capital. And obviously we are going to have some category of people not paying and all. So basically paid up capital will always be after deducting calls in arrears. Understandable? Okay. So these are all the disclosure requirements I am explaining it to you. So in the notes to accounts of the company, in the presentation disclosure, all of these have to be given properly. What is the authorized capital? What is issued capital? What is subscribed capital? Okay. And then very importantly, in the balance sheet, what you see the number is going to be paid up capital. Okay. So that is the disclosure requirement. All right. Always understand, whenever company raises any new issue, any new shares, always remember to check whether the paid up capital is always below authorized capital. And if not, then there has to be a proper provision followed for alteration of the authorized capital, that is alteration of memorandum's capital clause, and only then it can be taken into account. Clear? All right. So that is regarding the different types. Then there is equity share capital and there is preference share capital. So obviously equity share capital, preference share capital, for each of them you are going to have authorized, issued, subscribed, called up, paid up. Clear? So for all of that, disclosure has to be given properly. Now, always remember, whenever you start doing the audit of the capital, the very beginning what you do, the very beginning that you are going to check is that you will have the balance sheet with you and you will see there are going to be previous year, current year, previous year figures given to you. Correct? So obviously with this figures comparison only, the beginning will be there. That is the very beginning of your procedure. The very beginning of your checking will start from here. That means you will see that, okay, last year we had 120, now also it is 120 crores. That means there has not been any change in the share capital. So this gives an understanding that there has not been any increase in the share capital, there has not been any redemption of the share capital. But obviously, looking at it, you require to have a confirmation coming from the management. So what do you do? From the appropriate level of management, you take a written representation that there has not been any kind of change in this particular capital. So the appropriate level of management here is the company secretary. Okay. So you take a written representation from them, telling them, acknowledging that there has not been any change in the capital of the company. However, second scenario would be where previous year it was 120, now it is 130. That means there has been increase in the capital. That means there has been issued. They have issued capital during the year. Okay. See, obviously this cannot be so easily understood because there is a reconciliation. There could be opening balance, there could be issued capital, there could be redemption. So taking into account all that, you need to understand and evaluate what has happened here. Okay. So I'm just taking a simple understanding for you. If there has been an increase, so the understanding would be their capital has been issued. Now when there has been an issue, now the auditor will verify everything with regard to issue. That is, first verify the prospectus. All the provisions with regard to Companies Act 2013 with respect to issue of prospectus, allotment of securities, all of that you have to check. So what is that? Prospectus, whether prospectus is properly filed with ROC. Then after that, you will see whether it is within the norms of authorized capital, and authorized capital you will be able to check where? In the memorandum of association. Correct? Then you will see that whether issue has been within the limit of authorized capital, paid up capital, not exceeding that. Correct? Then whether application money has been received, whether minimum subscription has been achieved, only then they have gone for allotment, whether allotment has been completed within 60 days. So you can see minimum subscription, correct? Then 60 days, or if it is not received, it has been refunded within 15 days, correct? Then you have filed return of allotment with ROC, correct? Then if suppose issued capital was exceeding the authorized capital, then there has to be an alteration of authorized capital, correct? So if you have to alter the authorized capital, that means you have to alter object clause of memorandum, capital clause of memorandum. For that we have the provisions. So section 61 of the Companies Act 2013 gives you how you can alter the capital clause. So you have to file ordinary resolution, correct? Then in that case you have to first obviously board resolution, then you will be having ordinary resolution to be passed. Then you have to file the altered copy of the memorandum with the ROC. So all of that you have to check, correct? So basically these are the things that we have to understand, that how capital clause has been altered properly or not. Okay, whenever there has been issue of shares, one very important point, issue of shares, always remember there has to be a board resolution, plus there has to be a shareholders meeting conducted where required resolution has been passed. So you have to ensure whether If capital clause has been altered, then whether section 61's provisions have been complied with, all the provisions and information to ROC and all have properly been given. And if it is issue of capital, then whether board resolution has been passed, whether shareholders resolution has passed with this regard, correct? All of that is what you will check. Clear? Then you should see whether shares are issued at a discount, it is prohibited. Then you have to see whether if shares are issued at a premium, then have they complied with all the provisions of section 52. Correct? So basically, if it is a listed company, you should see whether all the SEBI guidelines have also been followed. Correct? The forms SH7, when there is an alteration in the capital clause, whether that is filed with ROC. PAS, okay, those things have been filed properly with ROC or not. So all of these things, if you look at it, they are all coming from where? Company law. So once you start entering into the flow, one by one, everything will start falling in place. Okay, and one after the other, you'll understand, okay, this procedure, then that procedure, and basically an answer will be ready. So what we have discussed here is very simple. I simply told you about a company when they have to issue the shares, what they'll do? Prospectus. Then application money will be received. This application money, it should be fulfilling the requirement of minimum subscription. Only then you can move for allotment. The allotment will happen within 60 days. Correct? If not, refunded back to all the applicants. Then you can have application, allotment, call, all the stages. Correct? What is calls in advance, calls in arrears, whether proper accounting has been done or not, disclosure has been done or not. Different types of different classification of capital. Authorized you'll find in the memorandum. Remaining all you'll see in the notes to accounts, and also you'll be seeing that in the paid up balance sheet, paid up capital, you'll have all the details available. So accounting has to be done appropriately. Different types of capital, each class of share, equity, preference. For each class of preference shares, like you'll have different percentage wise, dividend wise preference shares, different type, cumulative, non-cumulative, redeemable, irredeemable, correct? Then you'll have convertible, non-convertible. There are different types of participating, non-participating preference shares. For all of it, separately you have to show it. Then how you begin the checking, compare with the previous year, current year. If there is no change, obtain a written confirmation. If there is a change, there could be an issue. So based on that, you have to check whether issue has happened as per the requirement of the Companies Act. Prospectus has been issued properly, filed with the ROC or not. Okay, then based on that, whether minimum subscription has been received, what is given in the prospectus, whether company has moved in for allotment within 60 days. If not, have they refunded back within the given timeline, correct? Then after that, whether they have filed all the forms with the ROC, return of allotment has been filed or not, correct? Then after that, one more important thing, whenever company receives application money, we have a provision regarding keeping it in a separate bank account in a scheduled bank. So whether company has actually kept the money in a separate bank account, in a scheduled bank, it should not be merged with the company's funds. So you have to keep it in a separate bank account, correct? So that also has to be checked whether a scheduled bank account has been opened and separate, account has been maintained for the application money, correct? Then when the capital has been issued, whether it is within the line of the authorized capital you'll find where? In the memorandum. And if it is exceeding that, there has to be alteration to the authorized capital, for which section 61 of the Companies Act had to be followed. You have to pass a ordinary resolution, correct? Conduct a shareholders meeting, pass a OR, file the altered copy of memorandum with the ROC, correct? All of these things we do. And if suppose you're going to issue the capital, then that also cannot happen with a shareholders resolution. So a general meeting has to be conducted, whereas a resolution has to be passed. Along with that, there has to be a board resolution also. So you will be having access to all of this. So see that all of these things have been done correctly or not. Then if issue of share has been done as a discount, it is prohibited. So check if any of those things have been done. If it is issued at a premium, then see whether accounting for that is done correctly or not. Utilization of premium amount is done correctly or not. All of that we have to check. So basically it is a flow in which we are studying this. Clear? Okay. So with this backdrop, let us have a part of its reading so that things will be very simple to you. So now, audit of share capital, look at this, assertions to be examined here, existence, completeness, valuation. So now you understood how the discussion is. I told you there are certain parameters against which we are going to validate our checking. That means how are we going to check? So here first we look into the existence, that is to establish the existence of share capital at the period end. Okay, completeness, to ensure equity balances that were supposed to be recorded have been recognized in the balance sheet completely. Okay, that means completeness. And valuation is to ensure that equity balance have been valued appropriately. Equity balance as in calls in advance, calls in arrears, these all have to be taken into account, correct? So all of that. Then presentation disclosure is also the assertions here to check whether required disclosure for equity have been appropriately made. Okay, so the assertions that we are going to validate throughout now is going to be existence, completeness, valuation and presentation disclosure. Clear? Alright. Now look at this. I told you we are going to bifurcate our discussion into two parts. Okay. So what will be the two parts? First we'll take all the general procedures and then we'll talk about specific matters. Okay, specific matters are basically share capital by some provisions of the Act, like issue of shares at discount, issue of shares at a premium, issue of sweat equity shares, reduction of share capital, bonus. For that, there are certain specific provisions which you have to fulfill. So we need to verify them, but they're specific matters. So we'll take them separately. So generally, how do you check? All right. Now, I told you, have an imagination in your mind that whenever you are going to begin the audit of a share capital, or whenever you begin the audit of share capital, the understanding is you always do first the comparison of the previous year with the current year. That will always give you a beginning or the start to understand whether there has been any change or whether there has not been a change. If there has not been a change, then okay, fine, there has not been any movement in the share capital. So we'll ask the management, the appropriate level of management, to give us a written confirmation that there has not been any change in the capital. That is very simple. But if the figures are changing, that means there has been an issue, correct? If it is increased, there is an issue, or if there has gone down, there has been some kind of redemption. That could be basically for preference shares, correct? So there has been a issue, we'll take an example of where it is increasing. So there has been an issue. Once you understand there has been an issue, then the understanding will start in a different manner altogether. Issue means there are all the provisions with regard to prospectus. There are provisions with regard to, even if you talk about preferential allotment, there are certain criteria to be fulfilled. Okay, certain provisions of law like section 42 gives a big list of how many people you can allot to, what should be the maximum numbers. Okay, like more than 200 people, preferential allotment cannot be done. Correct? Who will not be counted, who will be counted, what kind of resolutions you have to pass. Okay, how many resolutions will you require? What is the limit for which SR has to be passed, or where board resolution alone will be sufficient? All that you do as a part of section 42. So that we will check. If it is a public allotment, that is, it's a general offer made to the public, okay, then in that case, we also have to look into application, minimum subscription, return of allotment, whether allotment has been done within the given timeline or not, all of these things. So once you start making an answer, the flow will be there. But you have to remember your knowledge about company law in this matter should be really good. Then the flow will be proper. Clear? Okay, so let's do it. Compare the year-end balances of authorized, issued, paid up capital to that of the previous year. I told you, you always begin with the comparison. Okay, so you will have start comparing. What? Authorized capital. Because if there has been a change in authorized capital, you have to check with the compliance of section 61. If issued capital has changed, then you have to move in for all the stages of allotment like section 38, section 39, 41, 40, underwriting contracts also will be entered if there is an issue of capital. Allotment section 39, correct? All of that you have to take into account. Okay, then paid up capital for appropriate accounting and all. Okay, calls in arrears, calls in advance have to be adjusted properly. So all of that we need to understand, correct? So if there has been any change in this, that will be the beginning of our discussion. So first compare the year-end balances, if authorized, issued and paid up capital to that of the previous year's audited financial statement. If there is no change during the year, obtain written representation that there were no changes in the capital structure during the year. Agreed? Then, if there is any change, now comes the second part. Obtain certified copies of the relevant resolution passed at the meetings of the board of directors, members authorizing the changes in the authorized and paid up capital. See, whether you are issuing a capital or whether there is going to be a, when you talk about authorized capital being changed, then as per 61, you have to pass ordinary resolution compulsorily. So that resolution also you have to obtain. Suppose you are issuing sweat equity share, there has been an issue of capital. So when you issue sweat equity share, you have to obtain special resolution from the shareholders. So special resolution also you have to obtain, correct? So you will obtain certified copies, okay, of the relevant resolution. Relevant resolution means for that particular issue, what kind of resolution is required by law, whether company has passed that resolution or not, that copies you have to obtain, okay? So we know board resolutions, general meeting resolutions, they are different. Members resolutions are different. Board resolution will be happening in the board meeting. So these will be obtaining, okay? Then obtain a copy of form SH7 for increase in authorized capital and form PAS3. PAS3 is return of allotment, okay? Whenever you issue shares, okay, and when you allot the shares, you have to always, after completion of allotment, file with the ROC, with the MCA, form number PAS3, which is called as return of allotment, giving details of everything regarding your allotment. Okay, the total shares allotted, at what price, okay, number of people allotted, all of that, all the details, when will the allotment closed, everything will be given to the MCA. Details will be given. That is PAS3. These form numbers I would recommend you remember. It could be tested for MCQ. Okay, so you can see here SH7 is increase, or we can simply say alteration of authorized capital, basically capital clause of memorandum, and PAS3 is increase in the paid up capital and verify the number of securities issued along with the issue price. Okay, so PAS3 basically the return of allotment. Then verify whether paid up capital as at the year end is within the limit of authorized, because the maximum capital is authorized capital and the paid up capital obviously should be within it, correct? Then in case of increase in the authorized share capital, verify whether company has accurately calculated the fee and the stamp duty payable to MCA and obtain a copy of receipt in support of the payment mode. Meaning is, whenever the company issues capital, alters the capital, then in that case they have to pay stamp duty. Okay, stamp duty will be depending upon the state law. So in the state where the registered office of the company is situated, based on that state law, you have to calculate the stamp duty valuation, stamp duty fee and pay it to the government. Okay, that is what is required. That has to be paid to MCA depending upon the state law, compulsorily, and fee to be paid to the ROC. See, whenever you do anything, alteration and all these documents have to be filed with ROC. So whenever you file any documentation with ROC for it to record it, then you have to also pay the fees to ROC. So fees as well as stamp duty in this case, depending upon the stamp valuation as per the state law, you have to make the payment. So for the payment what you have done, there have to be certified copies available, which we are going to verify to ensure that everything has been paid correctly. Clear? So these points, general points, don't you think they are very simple? Yes. What are they telling? First, compare. No change, obtain written confirmation from whom? Company secretary, written representation. If change is there, then issue of capital. So all the resolutions, board resolutions, shareholders resolutions have to be passed, obtain certified copy about it. If it is the issue of capital, very much it should be within the authorized capital, that also we have to check, correct? When there is going to be an issue, then in that case you have to file return of allotment with ROC, PAS3. And if there is alteration of the authorized capital, then there has to be SH7 filed with the ROC, that is MCA, correct? Whenever these kind of changes happen in the capital, you have to pay stamp duty, okay, depending upon the stamp valuation of the particular state, and pay it to whom? ROC, along with the registration fees that you file with the ROC. So fee as well as the stamp duty, all have to be paid. And we as the auditors have to check whether these duties, these fees have been appropriately paid or not to the ROC. Clear? So that is very simple. That is general points. Clear? Now we talk about audit procedure in special cases. Now when you talk about special cases, okay, special cases, first one is issue of shares at a premium. Now when you talk about issue of shares at a premium, the understanding is we have shares issued at par, shares issued at discount and shares issued at a premium. A 100 rupee share face value issued at 100 rupee par, 100 rupee issued at 80 discount, which is now prohibited, and 100 rupee share issued at 120 more than the face value is premium. You already know about it. Here the understanding is, we know the concept of premium. Our requirement as an auditor is to see whether accounting, utilization of the amount, everything has been done appropriately as required by the law. So now a 100 rupee share when issued at 120, we know the additional 20 rupees has to be gone where? It has to be credited to the securities premium account. That reserve it has to go, correct? That is one thing. So you have to see the proper accounting has been done, that you don't credit this amount to the capital, it has to go separately to securities premium. This securities premium is a restricted reserve. It cannot be utilized for any reason. As per section 52, they have given very clearly utilization of the reserve, and apart from that, no other places the reserve can be utilized, correct? So they have given you 5 places or 5 utilization for this reserve, and apart from that, this reserve cannot be used for anywhere else. But now, because there has been some companies which have to comply with Ind AS, okay, which are the accounting standards as under section 133, for them the utilization is even more restricted. So out of the 5, they can be using it only for 3 reasons. So this is the basic understanding of section 52 for us. But now you are not the person who has to comply, you are not company, you are auditor. So when you are auditor, obviously, first thing you have to check whether shares are issued at a premium. Okay. Now the additional amount received over and above the capital, that is the face value, whether they have credited to the appropriate account called as the securities premium reserve. Okay. Then during the year, have they utilized the amount from this account? If yes, is this amount utilized only for those purposes which have been used, which have been given where in section 52? If it is not utilized for that particular reason, then this is going to be amounting to reduction of share capital. Correct? So basically because of that, we have to be very particular that we check all these things correctly. Also understand there is absolutely no upper limit as to how much should be the premium amount. So a company can issue a 1 rupee share at 100 also, no problem. But this accounting, disclosure, utilization has to be done appropriately, and that is what the auditor has to verify when you talk about the first specific case, and that is issue of shares at a premium. Clear? Alright. Now, issue of share at a premium. Where a company has issued shares at a premium, whether for cash or otherwise. What is otherwise? We know the concept. Shares can be issued for cash or for consideration other than cash. So sometimes what happens is from the vendors, that is the suppliers of the plant and machinery, okay, which is, sometimes extremely the premium pricing and all, like 100 crore, 20 crore, 30 crore worth rupees machineries and all. So in these cases, usually there could be a normal understanding or a normal business transaction where companies will issue shares, okay, to the vendors. So here in return, what you have got on one side, it is not cash, it is the machinery coming in. On the other side, you are issuing the shares. So you have got a consideration, but which is other than cash. Correct? So this is consideration other than cash. Clear? Alright. Sometimes we also make the payment to underwriters. Okay, underwriters are what? Those, to whom we give the a contract for the subscription of a security. So they are going to get our shares subscribed. They take a very huge risk that if there is an undersubscription, okay, they will themselves purchase these shares. So basically the capital market intermediaries, banks, financial institutions, okay, mutual funds and all, these become the underwriters. Okay, so basically they underwrite the subscription of the share company, that is 90% of the shares they underwrite. The understanding here will be they will make sure that the shares are subscribed by the public, for which obviously the risk is high, so they will be getting commission. But here the best part is if suppose the public do not subscribe for the securities, the underwriters will subscribe for it. So the risk taken by them is very high, so the commission also will be high. So sometimes this commission also they can give in the form of shares. Correct? So here also you got a service of theirs, but you are giving them other than, so you are issuing shares to them in consideration other than cash, that is for their service. Got it? So that is also what? Consideration other than cash. So whether for cash or otherwise, companies shall transfer the amount received by it to securities premium account and state that the means in which the amount in the account can be applied. That means very clearly they have to use it, means is utilization. Correct? Now, as per section 52 of the Companies Act 2013, the securities premium account may be applied by the company only for the following purpose. Now, these things, if you have already studied company law, will be very, very simple for you. Okay? However, let us have a discussion in detail. First thing, the first place where you can use it is for the issue of fully paid up bonus shares. So, bonus shares, when you capitalize the reserve, you can capitalize even securities premium. So securities premium can be utilized for the purpose of issuing fully paid up bonus shares. Okay. Then second, for writing off preliminary expenses of the company. Preliminary expenses are pre-incorporation expenses. Okay. All the expenses incurred for the purpose of incorporating, like printing the memorandum, articles, okay, project reports, feasibility study, all of that we do. So there is going to be a lot of pre-incorporation expenses. For that to write off also, we can use securities premium. So that is preliminary expenses. Correct? Then third, DEF, that is expenses, commission and discount allowed on any issue of shares or debentures of the company. So obviously shares, very rarely we see discount, but debentures obviously discount is there. Correct? So when whatever expense is there for the issue or whatever commission you are paying, commission I told you just now for underwriters, or discount that you have given on the issue of shares or debentures, all of these can be written off against what? SPR. So how to remember this? DEF, discount, expense and, sorry, DEC, sorry, it has to be D, E and C. It is discount, expenses and commission. Okay, so discount on issue of shares or debentures, expenses on the issue of shares or debentures, and it is commission on the issue of shares or debentures. Commission, as I told you, underwriting commissions and all. Okay, that can be written off against SPR. Okay, then D, many students do it wrongly. The reading goes inappropriate, so you should have a proper reading for the same. Providing for premium payable on the redemption of any redeemable preference share or any debenture of the company. Now understand the concept here. They say that suppose you have issued a preference share for 100 rupees and the promise for the repayment or the agreement for repayment is that you will repay at 120. That means 100 is face value, but 20 you are going to give as premium. Understand, SPR cannot be utilized to pay the 100 rupees. SPR, that is securities premium, can be utilized only and only to pay this 20 rupees. So securities premium can be used only for the purpose of paying the premium payable on the redemption of either preference or debenture. So entire amount of redemption cannot be paid from SPR. Only what can be paid? Only the premium payable. So only the additional premium that you are going to pay on the time of redemption, for that premium can be utilized from securities premium. You cannot pay the full amount. Okay. So now read correctly. Providing for premium. This word is very, very important. Payable on the redemption of any redeemable preference shares or any debentures of the company, or for the purchase of its own shares or securities under section 68, and that is buyback. Buyback. Okay. So quickly, third one is what? It is for writing expenses, discount and commission. That is on issue of shares and debentures. One is issue, other is repayment. So when you redeem, obviously equity cannot be, redeem preference shares, redeem debentures. Okay. That time whatever premium you are going to pay, that can be used from securities premium. And finally what we are saying is, the last one is for buyback. Only and only for these 5 reasons, securities premium can be utilized. If for any other reason you utilized, that will amount to reduction of capital. That will not be permissible absolutely. Clear? So only for these. So we as the auditors, what we have to verify? First we have to verify whether the provisions of section 52 of the Companies Act have been duly complied with, and then in the answer you have to write the securities premium. We have to verify whether the securities premium amount is utilized only for the following purposes, and then you give the answer accordingly. Clear? Alright. Auditor needs to verify whether premium received on shares, if any, has been transferred to securities premium account, and whether the application of any amount out of the securities premium account is only for the purpose mentioned above. Understandable? Simple. Okay, that is only what we check. So understand the provision and based on that you give your answer. Clear? Alright. Now there is one more point that you have to remember. Okay, very, very important. Now when you talk about securities premium, okay, now the bifurcation you should understand in 2 ways. Okay. Now those companies which are required to prepare their financial statement by complying with those accounting standards which are given under section 133 of the Companies Act. So basically financial statement in compliance with Ind AS. Okay. For those companies, okay, prescribed class of companies, that means those companies whose financial statements have to comply with the accounting standards prescribed under section 133. That is, financial statements should be prepared in accordance with Ind AS. Those, okay, for them securities premium can be utilized only for 3 things. These 3 things are not different from all the others. Okay. See, other companies, all the other companies, for them 5 we have studied. What are 5? First, fully paid up, bonus, shares, writing of preliminary expenses, then writing the expense, discount and commission on the issue of shares or debentures, then premium payable on the redemption of preference shares or debentures, and then finally we have buyback. Correct? They are the 5 things. But now some prescribed class of companies which are required to comply with accounting standards under section 133, okay, for them securities premium can be utilized only for 3. Out of these 5, only 3 they can use. So first is this one, that is they can use it for bonus. Okay, then they can use it for writing of expenses, discount and commission, okay, on issue, and finally they can use it for buyback of shares. as per 68. Correct? So this thing one you have to remember, okay? So securities premium, when you talk about utilization, you have to categorize into two parts. One is all the companies, that is, we can just keep it like, we can first have a specific thing, that is those companies whose financial statements have to comply with the accounting standards under section 133. In simple terms, we talk about Ind AS. For them, SPR restriction is even more. They can use it only for 3. And all the other companies can use it for 5. Correct? So that you have to check. So which company's audit you are doing, based upon that you have to decide whether they are complying with the provisions of section 52 correctly or not. Correct? So that is one additional understanding that you take home here. So here you simply have to add one more point, and that is regarding companies whose financial statements have to comply with accounting standards under section 133. For them only 3. Okay, that you have to remember. Now moving on to the next one, the second specific matter that we have is issue of shares at a discount. Now what is discount? Discount simply means 100 rupee share issued at 80. This is not allowed, totally prohibited. An allotment like this is going to be void. Okay, this is totally prohibited by the company law, not acceptable. Alright. So obviously, if suppose there has been an issue of shares in the company during the year, which we saw in the general procedure, how we understand. So there we also have to check whether company has issued any shares for discount. And if that has been done, such kind of allotment is going to be void. Okay. Also understand, if the companies issue share at discount, then they have a punishment. So obviously, you should understand what will be the punishment if the companies issue shares at discount. However, there are two ways through which companies can issue the shares at discount. One is section 54, that is issue of sweat equity shares. See, 52 is premium, 53 is discount, 54 is sweat equity share. See, sweat equity shares are those shares which are given to the directors, the employees, because they have contributed something significant, okay, something out of the box. They have tried to bring intellectual property rights to the company, some kind of value addition that they have done to the company, for which the company wants to reward them in the form of offering them the ownership, a part ownership, or a way in which they feel more connected to the company. They want to reward them in a very better manner, in a very good manner. So in that case, they will give them sweat equity shares. So basically, understand with the word, equity shares have been given to them for all the hard work. Okay, so we call them to be what? Sweat equity shares. Now only, okay, for sweat equity shares, they are telling, even the language used in sweat equity shares is notwithstanding anything contained in section 53. Okay, company can issue the sweat equity shares at discount. So when shares are given to the employees, okay, for the contribution that they have done significantly to the companies, then in that case, for them the shares can be given at a discount. Sometimes they also give them for consideration other than cash. So money only is not taken. For whatever service they have given, for whatever intellectual property rights that they have developed, for any value additions that they are doing, for them the shares will be given. So they are for consideration other than cash also. But companies will issue shares at discount also, and that is allowed if it is shares for whom employees and directors for sweat equity allotment. Correct? Second is where company goes in for debt restructuring. What is debt restructuring? Very simple. Suppose the company has taken loan from a bank and the company is unable to repay the loan. Banker is the creditor, correct? So in that case, they will enter into a scheme of restructuring the debt. So obviously company says, look, we do not have funds to repay you, but obviously we have to pay you in some way or the other. So we will offer you our shares at a discount, okay, for you to cover our entire loan. So what you do is, instead of making the payment, you are giving them the shares. In this debt restructuring, where you are changing the structure of your debt, okay, where initially whatever agreed upon is undergoing a change. For that, shares can be issued at a discount. However, here you will have RBI guidelines to be followed. Some norms are given that you have to fulfill, and if that you have fulfilled, only then the debt restructuring scheme will get approved and it can be taken into account. So here, debt restructuring also, shares can be issued at discount. That will not be void, provided guidelines issued by RBI have been properly satisfied by the company. Okay, apart from that, apart from these two, if the company issues shares at discount, it is going to be totally prohibited. Correct? That is what we have to check. So first we'll see if there is an issue of share. If there is, it has been issued at a discount. If it is issued at discount, it is going to be void. Company will be punished for it. If suppose it has been issued for discount, also check whether is it for sweat equity, which will be permissible. Then you have to check whether sweat equity provisions have been fulfilled or not. Correct? If it is not sweat equity, then see for debt restructuring. But if it is for debt restructuring, then see whether RBI guidelines and all the other norms have been fulfilled or not. All of these things you have to check in a flow. You need to understand it. Clear? All right. So now see, issue of shares at a discount. Section 53. A company cannot issue shares at discount as provided by Section 53 of the Companies Act 2013. As per Section 53, a company shall not issue shares at a discount except in case of issue of sweat equity shares given under Section 54 of the Companies Act 2013. I already explained it to you. Any share issued by the company at discount shall be void. No legal effect, absolutely. However, a company may issue shares at discount to its creditors. I gave the example of bank. When its debt is converted into shares in pursuance of any statutory resolution, plan, or also called as debt restructuring scheme, in accordance with any guidelines or directions as specified by RBI under the RBI Act and the Banking Regulation Act 1949. See, debt restructuring, always bank comes into picture. Okay, it's a restructuring of debt and all. So, RBI and Banking Regulation. These two norms you have to fulfill. Correct? Then. So, two way it is allowed. One is Section 54. One is you can do debt restructuring, but it has to be as per what guidelines? RBI and Banking Regulation. Where any company fails to comply with the provision of this section, now this is important. How you will remember is your call, because how to remember punishments is a very big question. Okay, so that requires a very good memory capacity. Okay. Where any company fails to comply with the provision of this section, such company and every officer who is in default shall be liable to a penalty which may extend to the amount equal to the amount raised through the issue of shares at discount, or 5 lakh, whichever is less. And the company shall also be liable to refund all the monies received along with the interest of 12% per annum from the date of issue of such shares to the person to whom such shares have been issued. So they are telling, suppose you have issued 10 crore, that 10 crore or 5 lakhs, whichever is lower, and along with that, whatever earlier you have collected, don't keep with you, that you have to refund along with 12% interest from the date of issue till the date of refund. Clear? So that is the understanding. Now what will the auditor check? See, this is the provision we understood. Now auditor will check. First I told you, see, first there is an increase, movement. If movement is there, there has been an issue. And if there is issue, that means we'll check whether it is issued at discount or not. So first, movement in the share capital during the year. Then verify that company has not issued any of its shares at discount by reading the minutes of the meeting of its directors and shareholders. See, obviously, the only way through which you can understand what has happened in the meeting, what decision has been taken in the meeting, whether board meeting or shareholders meeting, we don't have a time machine to go back and check everything. So obviously, all of this will be understanding through what? Minutes. So you will look into the minutes book and understand, oh, whether they have done any resolution wherein they are telling shares to be issued at a discount, because that will become what? Void. Then verify that whether company has issued shares at discount to its creditors, and if when its debt is converted into shares in pursuance of statutory resolution plan or debt restructuring scheme in accordance with any guidelines, directions, regulations specified by RBI Act 1934 or Banking Regulation Act 1949. Don't you think it is the same that we discussed? So first you study the provision and then only write verify, verify, verify. And how do you understand share has been issued at discount? First see whether issue is there. Okay, movement in capital is there, means there could be issue. If issue is there, I will look into the minutes and understand whether discount. If discount, then I will see whether it is without any reason, then it is void. If it is for sweat equity, we will see the compliance with 54. If it is for debt restructuring, I will see RBI guidelines and Banking Regulation Act. So is the structure falling in place? Very easily. Clear? All right. Now moving on to the next one. So we studied specific cases 2. Issue of shares at a premium, section 52, we have to verify all of it. Section 53, issue of shares at discount. We need to verify whether it has been issued at discount and also the other ways through which it is allowed. So one of the ways where discount is allowed is regarding issue of sweat equity shares. So when you have seen a movement in the share capital and you realize that yes, there has been an issue of share, and then when you look at the minutes of the board meeting and the shareholders meeting, you understand that yes, there has been an issue of sweat equity shares to the employees or the directors. Now in this case, now as an auditor, you will start taking up the next step. What is the next step? You will now see that, okay, sweat equity shares have been issued. So now there has to be a compliance with which section? Section 54, correct? So section 54 of the Companies Act 2013 discusses the concept of sweat equity shares. Sweat equity shares, very simple to understand. With the name itself you get it, that it is because of somebody's hard work. It is because of somebody's additional contribution. It is because somebody has really worked hard, got something more to the company for which the company is trying to reward, correct? By giving a part ownership to him, by allotting him equity shares. They are sweat equity shares, correct? Now, understand here the concept. What happens is when you're contributing to an intellectual property right, when there are some kind of value additions done by you, maybe you have bought in some kind of new innovation, or you have contributed something significantly for which the company has got a lot of benefit, okay, and it is going to have a benefit in the long run, then obviously you will get awarded or you'll get rewarded in that manner. So there comes a concept of issuing sweat equity shares. These shares will be issued in either discounted manner or free of cost. Free of cost, we don't call it to be free of cost because the person has given such service, and in consideration to that service we are giving him the shares. So it could be for consideration other than cash. So for the services he has rendered, we are giving him the shares. So it's for consideration other than cash. Okay, now always remember, whenever there is going to be issue of sweat equity share, there has to be compulsorily a special resolution passed by the shareholders in the general meeting. Okay, that is one important thing. Second, in that resolution which is going to be passed, decisions should be taken very clearly. That means you should understand in the resolution very clearly it is specified what is the price at which they are going to issue. If any, by chance if they are giving it free, that is consideration other than cash, price will not be there. Or if they are giving a discount, at what price, what is the current market value of that particular share, correct? To which category of employees are we giving it, to which category of directors are we giving it. All of that should be clearly given in that resolution. So the resolution, when you read clearly, an understanding should be there. Okay, keeping into mind all of this, a resolution has been passed. To whom to be given, at what price to be given, what is the current market price. All of this will be taken into account. Also understand, some parts are not covered in the material, but you can elaborate it much better. If you have a question only for section 54, like how do you verify issue of sweat equity shares, you can have all your knowledge brought in forward from what you study in the company law. So in company law, you also study about, this shares which are issued should be the class of shares which have already been issued, correct? Once the equity shares are issued, they will rank pari passu with, when sweat equity shares are issued, they'll later on after allotment, they will rank pari passu, that is equal standing with other equity shares. Their rights and responsibilities will remain the same, correct? Then you should see that these shares should be in a lock-in period of minimum period of 3 years, correct? Then we also talk about the kind of employees who can get it, correct? So they should be permanent employees, permanent directors, okay, either of the company, the holding company, its subsidiary, okay, all those kind of companies, directors and employees will be eligible. Then they have given a maximum limit of how much sweat equity can be issued during the year, which cannot exceed 15% of the paid up capital. And when you talk about a startup, it can go up to 50%, correct? So you can put in some additional points that you know from section 54, and we can say verify all of these things. Apart from that, understand if it is a listed company, you also have to check into the compliance requirement with SEBI. SEBI guidelines, SEBI should be properly complied with, all the regulations, rules and everything should be complied. So when these kind of questions are there, don't keep your answer restricted to what is given in material. You know section 54 from the company law that you study very well. So whatever provisions you know, you simply go on writing verify. Verify that it is within a lock-in period of 3 years, verify whether special resolution has been passed, verify whether shares are actually issued within 12 months of passing the special resolution, because the life of that resolution is only for 12 months. Verify whether proper filing of the resolution has been done with ROC. So you can go on writing your additional points here also. Okay, some points you freeze and keep it very clearly, because in exam you don't get that much time to think and bring in everything together. So some parts should be readily available with you, so that a question like this, you know to write an answer. However, you can actually bring in all the understanding of section 54 and write an answer properly. Clear? So I would not say this is the exhaustive the way in which the answer has to be written. Whatever you know about the compliance of section 54, you simply prefix the word verify this compliance, verify that compliance, and you can make a much better answer. Clear? All right. Issue of sweat equity shares. Sweat equity shares means equity shares issued by a company to the employees or the directors at a discount or for consideration other than cash for providing know-how or making available rights in the nature of intellectual property right or value addition by whatever name called. See, the very interesting way of giving the definition by whatever name called is today we do not know what kind of new things can come up. What new innovations can be made? So tomorrow any new thing could be bought up, something new could be bought in the market which is not aware also of. So because of that, that also could be considered to be a value addition. So by whatever name it is called, if it is a value addition to the business, then for that definitely they would be rewarded in the form of sweat equity shares. The auditor may see that the sweat equity shares issued by the company are of the class already issued. So there should not be a fresh issue of sweat equity. Okay, always it should be already existing shares only. A part of it only will be issued again in the form of sweat equity. And the following condition as specified in section 54 are to be fulfilled. Issue is always authorized by special resolution, I told you. This resolution should give the details of number of shares, current market price, consideration if you are collecting, which class of directors or employees are being shares issued, all of that should be there. Whether the equity shares of the company are listed on recognized stock exchange, sweat equity shares are issued in accordance with regulation made by SEBI, and if not so listed, the sweat equity shares are issued in accordance with such rules as may be prescribed. Got it? So understand, if it is listed, we have SEBI, and if it is unlisted, then we have company rules. We know Companies Act is rule-based legislation. So companies rules are there 2014. So whatever is given there, those you have to fulfill. Correct? So for other companies rules as may be prescribed, and for listed companies SEBI. Clear? Apart from that, you can add on points of special resolutions timeline. What kind of category of employees can get this? Lock-in period of this. Okay. Then what is the maximum limit on the issue of sweat equity for regular companies, for startup? All of that additional pointers you can add on, file with the registrar the required returns. All of that additionally you can file up, write up, and make a good comprehensive answer for yourself. Clear? All right. Now moving on to the next special aspect, that is we are going to discuss about reduction of capital. Okay. Now in reduction of capital, obviously you should have proper knowledge of section 66 of the Companies Act 2013, which explains the concept of reduction, also gives you an understanding about the legal provisions, the compliances that you have to do with respect to reduction of capital. So basically I'll just give you a proper backdrop so that you understand what is reduction, and then we know there are certain provisions to be complied with. Then basically keeping all this in mind, the auditor is simply required to check whether all these provisions of section 66 have been duly complied by the company or not, for which do they have proper documentation available where we could have proper evidences to ensure that compliances has been done or not. Okay. Now what is reduction of capital? When you talk about capital, it is basically a security which is available to the creditors, and based on this the creditors will be able to decide whether this is a security for the creditors, as in the creditors believe, okay, the company is having so much capital, that means today or tomorrow, some way or the other, we are going to get back our money. So basically it acts like a security for the creditors, any lenders for the company. However, if this capital is going to get reduced, it is going to be a significant matter, an important aspect. So reduction of capital basically happens for reasons such as where the company believes that there is extra capital flowing in the company, more than what is required. So they would require not to raise the further capital or call the the capital which is still not called up, like the capital has been issued but it is not still fully called up or fully paid up. So that part which is not required, they decide to cancel it up. For example, if they have issued a share of rupees 10, okay, and already 8 has been called up and 8 has been paid up. So now they decide that the remaining 2 rupees which is still not called, which is still not paid by the shareholders, this they do not require because already they have sufficient money in the company. So they want to cancel this capital which is already issued, okay, but now some part of it which is uncalled still, that they do not require because they have sufficient money. So this issued capital which is uncalled, that they want to go in for cancellation. Okay, this is one of the ways for reduction. One more reason could be that the company is into a lot of accumulated losses are there. So basically the assets are not representative of what they are actually. Okay, so maybe it could be said that the share price is actually 100, but when you look at the real value of the share, the intrinsic value, it is only 50. So basically there has been a fall in the value. So what they do is they try to reduce the capital. So there are some ways in which section 66 gives through which the capital can be reduced. But the understanding here is that this reduction of capital can happen only and only by the approval of the shareholders by passing a special resolution. And more importantly, you should also make an application to the tribunal, and only if the tribunal approves, okay, gives an confirmation that yes, you can go for reduction, only then it can be done. Apart from that, you also have to file documents with ROC, correct? With Registrar of Companies, there has to be proper documentation done. It has to be registered by the ROC.
then whenever the tribunal is going to give you permission, obviously they are also going to send some representation letters to central government, to SEBI, okay, to creditors, to ensure that none of them have any kind of dissatisfaction with this kind of reduction. And if any one of them gives any kind of reason for the reduction not to happen, it will be taken into account. And the company has to either satisfy them or do some kind of provisions for them. Only then they can move in for what? Reduction. So basically when you talk of reduction of capital, it is a serious matter where it is for strengthening the financial position, a kind of arrangement will be done. We call it to be internal reconstruction, also called as capital reduction. So basically your accounting entries also have to be passed properly. So all of this auditor has to check properly whether all these accounting requirement, legal requirements have been properly complied by the company or not. Okay. Also understand, when you talk about reduction, you need to properly bifurcate that when you talk about buyback of shares, that is section 68, that does not come in here. Okay, for that we have all separate provisions to be taken care of, and you have to look into compliance of those provisions. When you talk about unissued capital, okay, and that capital if you are trying to diminish, that is also not reduction of capital, because there you do not require central government approval, that is tribunal's approval. There you do not require a special resolution and all. That is diminution of capital, that is alteration of basically the authorized capital, okay, which is still unissued. So there also these provisions will not be applicable. When you talk about forfeiture of share, what is forfeiture? That is cancellation, when you do not make the payment. So in that case also we are talking about reduction, but here these provisions will not be applicable because tribunal's permission will not be required. So basically when you look at section 66, where they are discussing about the capital reduction, they have given some methodologies and they have given some legal requirement. So when you thoroughly go through it, you will understand all the legal requirement, and that is exactly what we are going to check here. So we are simply going to check whether the provisions of section 66 of the Companies Act 2013 with respect to reduction of capital, the methodology for reduction, all the provisions, all the approvals, okay, all the resolutions, okay, whether they are adequately passed or not, all the confirmations with the ROC, whether you are properly filed or not, okay, whether proper special resolution has been taken or not, whether all this is properly accounted or not, disclosure in the balance sheet, because when you write the name in the name of the company's balance sheet, you need to give the word and reduced, whether it is appropriately disclosed or not. That is what we are checking. Clear? So this is considered to be what? The compliance with section 66, which if in the company, if that particular year there has been a reduction of capital, then obviously the auditor has to ensure that this reduction is in accordance with section 66. Clear? All right. So with this, now let us understand what has been given as a part of the audit procedure. So reduction of capital, section 66, I would strongly recommend that before you read the audit procedure, your understanding about section 66 has to be thorough. Then whatever points you are reading now, that will not become an exhaustive list for you. In fact, you can add some more points and make your answer more comprehensive to understand what all to be verified by the auditor. Clear? All right. The duties of the auditor in this regard are as following. First, verify that special resolution has been passed for reduction of the capital in the meeting of the shareholders. So I told you one very important thing is special resolution has to be passed. Clear? Then check that the articles of association authorize the reduction of capital. Very, very important. Reduction can be done only if you are authorized by your articles. Next, special resolution, and then you require tribunal permission, and tribunal is nothing but NCLT. Correct? Now, examine the order of tribunal confirming the reduction and ensure that a copy of the order and the minutes have been registered and filed with whom? ROC. I told you have to file everything with whom? ROC. Correct? So if you look at that, the first pointers are very simple to understand. So what you will see, verify first whether articles of association authorize reduction. I would recommend this to be the first point. Second, whether company has conducted a general meeting and special resolution has been passed. Clear? Then tribunal has given the approval, that is order of the tribunal has to be verified to ensure that the order has been passed. And finally, whether all of this tribunal's order and this resolution, all of this you have duly filed with whom? ROC. And you know very well by the company law provisions that special resolution always you have to file with ROC. And this confirmation order also has to be going to whom? ROC. So whether company has done this kind of legal compliance or not, also we have to check. Clear? Then inspecting the ROC certificate as regards to reduction. So once you file the documents with ROC, ROC also will give a certificate for reduction. So that also we have to check. Correct? Then I told you accounting is very, very important. In fact, when you study the accounting subject, okay, you'll study a topic called as internal reconstruction. So basically that is nothing but a kind of reduction that we are studying. So there you see how accounting is done. So all the journal entries are passed. So all of these things have to be done appropriately. That also we have to check. Vouching the journal entries recorded to reduce the capital and to write down the assets by reference to resolution of shareholder and other documentary evidences. So when you're going to check in the resolution of the shareholders, there you'll understand, okay, which all assets are going to be written off. Okay, based on that accounting entries have to be cross-verified. Okay, then, sometimes the assets are overstated, correct? So the reduction basically is done why? To come to a correct picture. So I told you when there are accumulated losses, so these all have to be written off. When there are, intangible assets overvalued, they also will be written down, correct? So we have to see as per the resolution, reduction has been done for what all purposes, and based on that the accounting has to be done accordingly. Writing off of the accumulated losses, writing down of these intangible assets, correct? All of these have to be taken care of, correct? Then, ensure that the requirement of Schedule 3 with respect to reduction of capital have been complied with. Then confirming that revaluation of assets have been properly disclosed in the balance sheet. Okay, so disclosure has to be done correctly, what was the original value and what is the revalued one. Then, verifying the adjustment made in the members account in the register of members and confirming that either paid up amount shown on the old certificates have been altered or new certificates have been issued in lieu of the old and the old ones have been cancelled. Now what is the meaning of this? Just now I explained that reduction, one of the methods for reduction is that the uncalled capital, okay, could be extinguished. Extinguished as in you don't have to call it, you not call it. Okay, like suppose you have issued a share for 10 rupees, okay, on which 8 is already called and also paid by the members. There is 2 rupees still uncalled. Now company believes that there is enough capital floating in the company, there is sufficient capital for the requirement. So what they do is they decide to extinguish this capital. Extinguish as in we are not going to call and we are going to cancel this part. So now the share will be 8 rupees fully paid up. Correct? Because they are never going to call the 2 rupees. Understanding? So it became what? 8 rupees fully paid up. Now this old certificates which are issued are having 10 rupees where 8 is called up. But now you are never going to call the balance 2 and now the new value of the share is going to be how much? 8 rupees. So because of that either there has to be alteration in the old certificate and make it to be what? 8 rupees, or basically what happens in reality is that new certificates only have to be issued. So in this case the new certificates will be issued with having 8 rupees as fully paid up. And obviously we maintain the register of members. Under section 88 of the Companies Act 2013, register of members is mandatory. In this register of members, we see that the details of the members will be given. There one of the understanding is regarding the share certificate, the amount of shares held, the called up value, paid up value of the shares. So there also changes have to be made. So we as the auditors have to ensure that the requirement of section 88 for the updation of this kind of details in the register of members, along with that share certificate which are issued, either alteration in the original one or new issue, whatever they have done has been done properly or not. Okay, so that is the understanding. So look at that, verify the adjustments made where in the register of members, so section 88 is duly complied with, and confirming that either paid up amount shown in the old certificate have been altered or you issue completely new certificates which have been issued in lieu of old, and obviously when you issue the new certificates care has to be taken that old has to be what? Cancelled. Clear? So that is the understanding. Then this is important for disclosure requirement which is mandatory. Confirming that the words "and reduced" if required by the order of the tribunal have been added in the name of the company in the balance sheet. So whenever the company's balance sheet appears, it will be balance sheet as at or balance sheet as on, and in the bracket you will read the word "and reduced." If in the tribunal's order it is given that the company has to use this word, and they will also specify the number of years for which the company is required to mention the word "and reduced." So based on the tribunal order which we have already checked, based on that we will understand for how much period the company is required to mention the words "and reduced" in their balance sheet. Clear? So that is important. Verify the memorandum of company has been suitably altered if required. Okay, if this leads to the alteration because if the nominal value of the shares is cancelled, then in that case the alteration of capital clause also will be required. because we already studied that when you talk about capital clause, I mean memorandum, okay, capital, we also see that in authorized capital we write number of shares and a face value per share, correct? So because of that, if there is an change there, face value is changing, that means memorandum also has to undergo a change. So wherever there is an alteration done there, that also has to be properly checked by the auditor. Clear? All right. So verify memorandum of association, the company has suitably altered or not. So you can look at this. Okay, very simple pointers for us to remember. So quickly, first, always go in sequence. Imagine first you have the articles. In article there is a permission, but then we know we compulsory have to pass special resolution. Special resolution, then tribunal's order. This order you have to pass with whom? ROC. When you file with ROC, ROC will give you certificate. So as an auditor, I have to check all of these documentations I have to check. Correct? Then apart from that, accounting entry is very important because financial statements I verify. Disclosures as per Schedule 3 requirement. Revaluation of assets have to be properly done. So whatever is decided in the general meeting, based on that only revaluation is done. Then because the valuation of shares and all will undergo change, that will have a change in register of members. Correct? Certificates already issued to them will also be either altered or new certificates will be issued. And if new certificate you are issuing, old have to be cancelled. Correct? Then tribunal's order we read and understand the word and reduced to be added to the word of the balance sheet. And then if memorandum of association required changes, then obviously it has to be suitably altered because sometime reduction will change the par value, the face value of the shares. Correct? So because of that, it has to automatically have a change where? In your authorized capital also. So because of that, what happens is memorandum also undergoes a change. So suitably it has to be altered. We have to check that itself. Clear? So that is what is required. Clear? And also remember, when you talk about buyback, it is section 68. When you talk about unissued capital, that comes as a part of diminishing of basically authorized capital, where that is section 61, which does not come in here. More importantly, forfeiture of capital is also not reduction. So you need to understand properly what comes under reduction and what is not covered by reduction, because all those places tribunal consent and all is not required. But here you require the permission coming from where? NCLT. Okay, so that is section 66. Now understand, when we studied audit earlier, the framework was different when it came to all these aspects discussion. So we were dividing the entire chapters into two parts, where we used to call it to be company audit 1, company audit 2. So in company audit 1, we used to have the basic provisions regarding appointment of the auditor, reappointment of auditor, qualification, disqualification. And when we discussed company audit 2, we basically had all these things. Like every item of balance sheet and the P&L of companies, we used to pick up and do the audit of that. So basically we did audit of share capital, audit of reserves and surplus. Then in audit of share capital, we studied different things like premium, discount, sweat equity shares, reduction, buyback, all of that. But here they have not taken each and every aspect that much in detail. So what we have done is you have understood that they are not discussing how you verify the audit, how you verify when there is a buyback happening. Okay, so basically specifically buyback provisions are not given. Okay, but however I would always recommend, because you have studied already the company law and you have already understood about the share capital topic, so see that when you study those provisions, study so much in detail that if a kind of question appears in the audit paper, which basically might not appear because in the material buyback and all is not specifically given, but suppose if it comes, you should know that only section 68 provisions, if you know properly for buyback, then you can simply go on writing the verification part. Verify whether board resolution is passed, verify whether special resolution is passed, verify whether buyback has happened within a given period or not, verify whether a return of buyback is filed with ROC or not, then verify whether these shares which are bought back are physically extinguished or not, verify whether the reserves utilized for buyback are appropriate or not, whether the amount utilized is within the limit or not. Correct? So basically all the provisions that you study as a part of section 68, all of those you need to verify. So even if you have an exclusive question coming on buyback, you should be in the position to answer. Clear? Alright. Now when you look at share capital, there is one more assertion which we have to check, and that is regarding presentation and disclosure. We have discussed about existence, we discussed about completeness, we discussed about valuation, when we discussed about the general aspects. Then we picked up the specific aspects and we only saw that the auditor is required to check the compliance and the accounting is done properly or not. Correct? There is one more very important assertion to be validated by the auditor, because notes to account form a significant part of the financial statements. So presentation disclosure is also to be appropriate. So we are talking about a company. So in company, the presentation and disclosure should be as per what? The part 1 of the schedule 3. Correct? So basically you're talking about the balance sheet item. and because of it, the part 1, schedule 3, okay, that has to be taken care of properly. So when you talk about share capital, what all is the disclosure requirement that we have to check? So we should understand, as per schedule 3, the part 1 of it, what all disclosure requirements are given for share capital, and based on that we have to check as auditors that whether the company has given proper disclosure with respect to every aspect that is required as part of the schedule 3. Clear? So let us see what is the disclosure requirement. This I would consider it to be one of the important areas for exam point of view. So you should understand the disclosure requirements properly. Okay, now for each class of share capital, when you talk about each class, we talk about equity share capital, preference share capital. For preference share also we have different category, like we have cumulative, non-cumulative, or we also have percentage wise the preference shares bifurcated. So for every class of preference share and every equity share, you have to give all these details. Okay, so what is this? For different classes of preference share to be treated separately. Okay, so each class of share capital, and apart from that for preference share also treated separately depending upon the different classes. First, the number and the amount of shares authorized. Okay, that is authorized capital always be given the form of number of shares into value per share. That is quite known to all of us. Correct? Then after authorized, we talk about issued, subscribed, paid, subscribed but not fully paid. Correct? So here partly paid up shares, all you have to give disclosure. So once you know authorized capital, next part is going to be issued, subscribed, fully paid up, and we can say subscribed but not fully paid, so partly paid up. Clear? All right. That is the next one. So these are number of shares. Then par value per share. Correct? So these three are basically something that you already know about it, where we are discussing about authorized capital, issued capital, subscribed capital, paid up which is fully, and then subscribed but not fully paid. Correct? Then apart from that you give one more information regarding par value. Correct? So these are the points. 3. Then look at this. A reconciliation of the number of shares outstanding at the beginning and at the end of the reporting period. What is reconciliation? Reconciliation simply means opening balance, add the issue during the year, less redemptions made, and that will give you the closing balance. So this movement that is happening in the capital, we call it to be reconciliation. So you have to give a proper reconciliation of the number of shares outstanding at the beginning. So how many shares were outstanding at the beginning? Add whatever is issued, less redemption, okay, and then you'll have the closing. Correct? So this number of shares have to be properly given. For equity, obviously basically redemption won't be there, issue could be there, preference, you could have all this category. Clear? So that is the next. The rights, preferences and restrictions attaching to each class of share, including restriction on distribution of dividend and the repayment of the capital. Okay. So now we know there are restrictions given, like we have shares with different rights, different privileges, like we have equity shares with DVR, correct? Then we have some kind of restrictions, right of lien and all. So all of these kind of restrictions and all, we need to give a proper understanding in the disclosure. So rights, preferences, restrictions. So DVR would be the best example. If you have issued equity shares with differential voting right, then what is the right associated? You have to mention it here, disclosure. Then F is regarding the holdings that is there by the holding companies and the ultimate holding companies. So if you're talking about a company C, okay, so you're doing the audit of C. Suppose in the company C, there is another company B which is holding shares, okay. So basically I'm talking about a holding company, okay, and there is another company A which is holding shares in B and B is holding shares in C, okay. So basically we call it to be what? Ultimate holding company. This is the holding company of C. Holding company should understand not less than 51% of the capital, correct. So basically if this criteria is fulfilled, then in this company, how much B is holding and how much A is holding, that also discussion has to be taken into account. So disclosure has to be given for that. Shares in respect of each class in the company held by its holding company or its ultimate holding company, including share held by or by subsidiaries or associates of the holding company and their ultimate holding company in aggregate. So basically the understanding is like this, okay. So we can say, suppose we are doing the audit of C, okay, B limited is holding of C company and A limited is holding B and B is holding C. So the understanding is this is B limited which is holding C limited and A is considered in the context of C to be ultimate holding company, correct. Now how much ever shares B Limited is holding in C Limited, and in each category, whether preference, whether equity, every kind of share, whatever they are holding in any class of shares, all the details have to be given. And what A is holding, that details also you have to give. In every class of shares, whatever they have, the number of shares that they are holding, that has to be given. Along with that, B will have its own subsidiaries, B will have their own associates, A will have their subsidiaries, A will have their associates. These also, what they are holding in C, that details also have to be given. Okay. So if you look at the English here, shares in respect of each class in the company held by its holding company and its ultimate holding company. So the company that we are doing the audit is C. Okay. So C is the company whose audit we are doing. Okay. By its holding is B, and its ultimate holding company, which I have taken example as A Limited. Shares held by, including, okay, shares held by or by subsidiaries or associates of holding. So holding is B, so B subsidiaries, B's associates, and ultimate holding company, A's subsidiaries, A associates. Whatever these are also holding in C. For all of that, how many they are holding, that we have to look into that. Okay, so that also disclosure has to be given. Disclose A Limited's holding, where in C Limited, then B Limited's holding in C Limited. Okay, then assuming this is Y and Z, okay, Y is supposing a subsidiary of A Limited and Z is associate of B Limited. Then we should also mention how much is Y Limited holding in C, and also A Limited, Z Limited holding in C. Okay, so this much combination you have to give an understanding. Okay, all right. Okay, just to understand properly about this related party purpose. Okay, then important is about this: shares in the company held by each shareholder holding more than 5%. Okay, shares specifying the number of the shares held. Okay, that means suppose Mr. A is holding aggregate 8% of shares, where in Z Limited. So in Z Limited's company, okay, notes to account, there has to be a disclosure requirement, name of this person along with what is his holding. Clear? That is the understanding. Remember this for MCQ, this could be questioned. Okay, then shares reserved for issue under options and contracts commitments for sale of shares, disinvestment, including terms and the amounts. This is nothing but we issue shares to the employees as options today, wherein they will not get the shares immediately, but there are some shares kept aside for them for the purpose that tomorrow after the vesting period is completed, okay, they can go and exercise their option, where they can buy the shares at the price which is pre-decided today. Correct? So these are the shares. So basically, if any shares are reserved like that as share options, then in that case you have to give about them the terms and the amounts. Terms would be what was the grant date, what was the exercise vesting period, what is the exercise date, what is the exercise price, all of those terms, and also the amount involved. Clear? So that is shares reserved for issue under options, contracts, commitments, etc. Okay, then for the period of 5 years immediately preceding the date at which the balance sheet is prepared, aggregate number and class of shares allotted as fully paid up pursuant to contract without payment being received in cash. In simple language, how many shares have you allotted for consideration other than cash in the last 5 years? Okay, then aggregate number and the class of shares allotted as fully paid up by the way of bonus shares. But you can understand here cash inflow is not there. Correct? Then aggregate number of shares bought back. Clear? So these things. So what they're telling, suppose you're preparing, the balance sheet is on 31st of March 2024. So you have to go immediately last 5 years. Okay. In this last 5 years, if there has been any kind of issue of share done for consideration other than cash, then what kind of shares and how many shares? Okay, disclosure about that. If you have given bonus, what kind and how many number, that, and if there has been a buyback in the last 5 years, that also has to be given. Where? In this year balance sheet. Disclosure has to be given. Clear? All right. Then some other things are there. Terms of any securities convertible into equity preference shares issued along with the earliest date of conversion in descending order starting from the farthest of such date. Okay. So we know there are convertible preference shares, correct, which will be converted into equity shares after a certain period of time. Okay, so on the descending order, the farthest first, like that you have to keep on recording it. Okay, the disclosure has to be given. So terms of any securities convertible into equity, any securities, because convertible debentures are also there, they also can be converted into equity. Okay, then preference shares issued along with earliest date of conversion in descending order starting from the farthest such date. Okay, then calls unpaid, showing aggregate value of calls unpaid by the directors and officers. Okay, you have to separately show this also. Then forfeited shares, amount originally paid up, that has to be shown. And company shall disclose the shareholding of the promoter, very, very important. How you have to show the name of the promoter, number of shares held by them, and out of total share, what is their percentage. Okay, and during the year if there has been a change. So they were holding 7%, if they have become 9%, then you have to tell during the year if there has been any change, this could be increase or this could be even decrease. Correct? That is the understanding. So basically you can see there are so many disclosure requirements that we have to check. Okay, for that it is very, very important, the assertion, presentation and disclosure when you talk about when it comes to share capital, very, very important for us to check because so many are there. Okay, so let us quickly go through one by one so that the understanding is crystal clear. Okay, so now first for each class of share capital, we talk about equity capital, we talk about preference, and preference also different class. Okay, all separately disclosure has to be given. First 3 points are very simple because that you already know that you do as a part of accounting also, very basic adjustments and all will be there. So you will see that you prepare schedules and all where you know you have to mention authorized capital, number and the value, correct? Then issued capital, subscribed capital, then you have fully paid up capital, okay, partly paid up capital, number and value. So all of that you definitely write, so you know that. Also par value of the shares, what is the face value, okay? So 3 things are quite simple. Then reconciliation is opening, add fresh issue, less if there has been a redemption, and finally there has to be, if there is a buyback and all that happening, that also has to be recorded, and finally you'll have the closing balance. So that is the reconciliation. Then if there are any rights attached, any kind of restrictions, okay, all of that has also to be given as a part of disclosure. Best example for you to remember is regarding your DVRs. Sometime on the shares there is a right of lien by the company, so there are some kind of restrictions on the payment of dividend. So all of that restrictions have also to be given. Clear? Then, when you talk about chain holding, here you have to understand that in the company which you are doing the audit, okay, you have to see whether disclosure is properly being given. If this company is having a holding company, then how much ever shares are taken up by the holding company in this company, disclosure of that. Ultimate holding company, so if there is a company which is holding the holding company, which is considered to be the ultimate holding company, what shares they are holding in that company, that also has to be disclosed. Subsidiaries, associates of this holding and ultimate holding company, if they also have securities or shares invested or having the number of shares in this company, those also disclosure you have to give separately. So that is all the proper bifurcation of disclosure you give. Then very importantly, MCQ I told you could be important. If any shareholder is holding 5% or more of the shares in a company, okay, in any class of the shares of the company, disclosure about him has to be given separately, where you mention his name and the kind of shares held by him and the percentage of shares held by him. Correct? Then if there are any shares reserved for options or any commitment for the future where after 2-3 years you have promised to issue as a part of a contractual agreement some shares, then those, how much they are, what is the commitment, what are terms, conditions, amount involved, everything has to be given. Okay. Then when you talk about any kind of these things that have happened in the last 5 years, okay, then in that case disclosure has to be given. So we are talking about you being in the current period, okay, immediately 5 preceding financial years. If there has been any kind of issue of shares for consideration other than cash, there has been issue of bonus or buyback, then disclosure about the same has to be given in any of the 5 immediately preceding years. Correct? Then what is that? Consideration other than cash, bonus and shares bought back. Then when you talk about any securities convertible, whether it is debenture convertible into equity or convertible preference shares, then write the terms and also earliest date of conversion, keeping that in mind, in descending order. Okay, you are going to write descending as the farthest will come first. Okay, keeping into mind the conversion dates. Okay, last will come first, like that you have to keep on recording it. And then finally, some other matters are there, calls unpaid specifically from the officers and the directors, then forfeiture, and finally, very, very importantly, how much promoters are holding. So promoters holding, you have to give name of the promoter, number of shares held by him, the class of security, and out of the total shares, what is his percentage. And during the year, if there has been a change in this percentage, then that also has to be properly disclosed. Correct? These are compulsory disclosures required by the part 1, schedule 3, and because of that it becomes very important for the auditor to actually go through all of them. Okay, so very, very important to validate our assertion of presentation and disclosure requirement. Clear? Only then the audit of share capital will be considered. These disclosures are mandatory, so non-disclosure of any of this would definitely amount to material misstatement, which would definitely impact our audit. Clear? So disclosure requirements have to be appropriate, and that is what we are going to validate. Clear? All right. Now moving on, there is one more important point regarding the disclosure requirements here. When you do audit of share capital, one more disclosure you have to check in detail. This is very, very important. Also understand, exam this could be focused on, and you would be asked to give a disclosure requirement here. I mean, how will the auditor verify regarding the disclosure in this particular matter? So what is this matter all about? Let us understand. Disclosure with respect to funds advanced or loaned or invested with other persons. What is it? Funds advanced, loaned or invested with other persons. Now, I'll first explain you what is this criteria all about, or what is the situation all about, and then based on that we need to understand if such kind of situation has happened during the year, or if it is prevailing in that company, then apart from all the schedule 3 disclosures that we have already studied, what additionally they have to disclose in their notes to account. Okay, and that is mandatory, which they have to disclose, and if that is not there, it is going to be a material misstatement. Clear? All right. Now first let us understand what the situation is all about. Here we are talking about, now suppose there is a company A Limited. Okay, this company A Limited, what they have done is, they have advanced some money. This money could be either from the capital, it could be from share premium, or it could be from the amount which they have borrowed, or from any other funds. So the company has certain funds which they have advanced to another person. This person could be a company, it could be any entity, it could be a foreign entity also. Okay, but they have given an instruction, or they have given an undertaking in writing to this person, this entity, that this money so forwarded, this money so advanced should be given to another entity, which we call it to be ultimate beneficiary. Means the company has advanced money to a person. Okay, it could be any entity, including foreign entity, with an instruction that this money should be further forwarded to whom? Another company, assuming it to be C Limited. C Limited will be considered to be ultimate beneficiary. Or do not advance this money to C Limited, but rather whatever borrowings which C Limited is giving, you can provide a guarantee for it. Guarantee on behalf of the ultimate beneficiary. For whatever task they have taken, you can stand as the ultimate guarantor. Okay, provide a guarantee on behalf of C Limited. So either you advance loan or you stand as a guarantee for them. Okay. Now this is a situation that we are discussing, where the company that we are doing the audit is A Limited. A Limited has advanced money to an intermediary in middle person. Okay, with the understanding that this money has to be given to the ultimate beneficiary. Correct? Now, this particular situation, if it is present, then A Limited has to give adequate disclosure in notes to accounts. And what is the disclosure is what we are going to read now. And based on that understanding, we as auditors have to verify whether when such kind of transaction is present, then whether this company has adequately given all the disclosure requirement as are required by law. Clear? All right. So what is the understanding? Company has advanced money to a person. This person could be any entity, any body corporate, any company, or even a foreign entity, with an understanding that this has to be given to another company which is going to be an ultimate beneficiary, or provide a guarantee on behalf of this company. Either directly you're funding or indirectly you're going to fund in the form of a guarantee. If this kind of situation is existing, then A Limited, okay, is required to show in its financial statement, in the notes to account, as a part of disclosure requirement, they have to give some details about this kind of arrangement. And what are these details? We'll have a reading now, and based on that we need to understand what we as the auditors have to verify here. Clear? All right. Now look at it. Now when you read it, you'll follow it very easily. Where a company has advanced or loaned or invested funds. From where? It could be either from borrowed funds, or it could be from share premium, or it could from any other source of fund, to any other person or persons, entities, including foreign entity, okay, whom we are calling as what? Intermediaries, with the understanding, whether recorded in writing or otherwise, that the intermediary shall directly or indirectly lend or invest in the other person or the entities identified in any manner whatsoever by on behalf of the company. That means what is the understanding? That these persons are going to forward it to where? To another person, which are identified by the company itself. So ultimate beneficiary, we only are going to decide, the company is going to decide, but it is going to be routed through the intermediary, correct? Or provide any guarantee or security or the like to or on behalf of what? Ultimate beneficiary. Okay, if that is the situation, then what will happen? The company shall disclose the following. What they have to disclose? First, date and the amount of fund advanced or loaned or invested in the intermediary with complete details of such intermediary. So first you disclose about the beginning. When did this happen? So when did A give it to the intermediary? Okay, so in this, when, how much, and who is this intermediary? If it is 2-3 intermediaries, all their names. Okay, so the beginning, date, amount, and complete details of whom? Intermediary. First point clear. Second, date and amount of fund further advanced or loaned or invested by such intermediary to other intermediaries or ultimate beneficiary along with complete details of the ultimate beneficiary. This was the first step. Now second, intermediary is going to transfer it to whom? Ultimate beneficiary. So again the same, when, how much, and details of them, who. Clear? So look at the date, amount, and who are the ultimate beneficiaries. Clear? Then if you are not giving funding directly, then guarantee we can give. So again here also same, date and amount of guarantee or security or the like provided to or on behalf of the ultimate beneficiary. So these first two pointers are first step to the next step. Second is where directly what guarantee has been given. So when and to what amount is the guarantee given. Also understand when I told you that this intermediary could also be what? A foreign entity. So when foreign entity is involved, if intermediary is going to be a foreign entity, then there is going to be a forest transaction for which there has to be guidelines compliance coming from where? FEMA, correct? So there you have to mention declaration that the relevant provision of FEMA, Foreign Exchange Management Act 1999, and the Companies Act have been complied with for such transaction. And very important, understand what we are doing. From one company it is going on to other, from other it is going on to the other, or from A it is going to B, there is another intermediary, maybe B1, another intermediary B2, then it is going to C. So you can see it is going through so many hands. There could be a scope of money laundering, correct? So company has to give a disclosure very clearly in its disclosure requirement and notes to account that they have not done anything which is going to amount to money laundering, correct? So that means the transactions are not violative of Prevention of Money Laundering Act 2002. Is the concept very simple? So if you look at it, step by step the disclosure is given. So we are telling disclosure is what? First A Limited to B Limited to C Limited. This is the company, this is intermediary, and this is ultimate beneficiary. We are focusing on what? Disclosure requirement. First disclosure is this company has given when, first this transaction you have to disclose. When, how much, and to whom. Correct? Then this part. Again when, how much, to whom. Easy? Then we know direct funding also could not be there, indirect funding could be there. That is nothing but guarantee also could be possible. So if it is guarantee, then only you have to write date and amount. And suppose if this intermediary is a foreign entity, then FEMA compliance and all the provisions of Companies Act also should be complied. Along with that, because there is a movement of money happening from different entities, there is a flow. Understand it should not be violative of Prevention of Money Laundering Act. Clear? Very easy way to remember. Don't try to by heart these things. You have to sequentially study. Clear? Alright. Then there is one more part here. Okay. One is where we have funded, we have transferred. Second is we have received. We have received means now we are coming in the position of what? Now we are A Limited. So now A Limited has received the money to be given it to some third company, let us say Z Limited. This is ultimate beneficiary. So we have received from maybe Y Limited, correct? Y Limited has given money to A Limited with an understanding that A Limited should give it to Z, correct? So now we are standing in the position of an intermediary, correct? So even in that case, if we are the receiver of the fund to be advanced to the next one, in ultimate beneficiary, then also in our notes to accounts, we need to have a disclosure requirement to be given, correct? That is what they are telling. English is very simple here. Funds are received from others. Where a company has received any fund from any person or entities, including foreign entities, with an understanding whether recording in writing or otherwise, that the company shall directly or indirectly lend to the, okay, on behalf of the funding party, that is they are going to lend it to the ultimate beneficiary or provide guarantee on behalf of the ultimate beneficiary. So you are standing in the position of what? Intermediary, correct? Then in that case, date and amount of fund received from the funding party, correct? With complete details of each funding party. Funding party means in the previous one we were funding parties, correct? So now we are intermediaries. So when did we get money from the funding party? How much did we get? Who is that funding party? All of that detail. Then next step is what? After I forwarded it. So when did I forward? Okay, on what date, what amount and to whom? Same logic here. Date and amount of fund being transferred to the ultimate beneficiary along with complete details of this beneficiary. Then again if it is guarantee, date and amount, and finally FEMA, Companies Act and Prevention of Money Laundering. Okay, all of these have to be properly complied with. Clear? Same thing it is. Only you need to understand step by step how disclosure you are going to give. Clear? Okay. So we as auditors have to verify whether these disclosure requirements have been adequately done by the management or not. Also understand, okay, just to connect you to another topic, when you will discuss about the topic audit report, okay, so you will be studying section 143 subsection 3, reporting on principal assertion, where you will be studying some matters regarding same pointers will come there. So there understand as per section 143 subsection 3, it is given as a responsibility to the auditor that the auditor is required to obtain a written representation from the management that there is no other transaction of this type, okay, existing in the business apart from what they have already disclosed. So understand what we are telling is, first of all, management has the duty to disclose all of it correctly. Where? In the notes to account. Okay. So these kind of transactions are not prohibited. They are allowed with adequate disclosure in the financial statements. However, as per section 143 subsection 3, when you are going to do it, okay, that time you will see the same pointers are going to get discussed. I am going to have elaborative discussion. In fact, I am going to make this concept even more elaborative for you to understand what is it. Okay. So there you will understand about the intermediary, you will understand about these things again. There in the context of the auditor to understand that the auditor as a part of his duty, he needs to obtain a written confirmation from the management that apart from what they have disclosed in the notes to accounts, there is no other funding like this which have been taken up by them. Okay. So we need to get an understanding in writing from the management, like a written representation from the management that look, whatever disclosure you have given in the notes to account, apart from that, such kind of funding arrangement has not been done by you. Got it? So that is what is required. Okay. So there also you will be reading the same thing, but there you will understand that auditor has to obtain written representation from the management. Here we are saying what is the disclosure requirement, and this disclosure requirement we have to ensure it is properly done or not. Clear? All right. So this is all regarding the audit of share capital. So what did we discuss? Very simple. First we understood about the general aspects. Then we discussed about issue of shares at a premium, where we only checked for the compliance of section 52 and the utilization of securities premium. Then we discussed about discount, where we focused on it being void, not allowed, okay, it's prohibited. and what is the punishment for the same, and based on that, which are those areas where you can go for issue of shares at discount. Provided there are certain provisions to be complied with, like section 53, and when you talk about restructuring of the debt, then you have to comply with RBI guidelines, correct? Then after that we discussed, and also Banking Regulation Act. After that we discussed about issue of PT, where you have to comply with all the provisions of section 53. Then we discussed about reduction of share capital, where I gave you the understanding of reduction, and also section 66 compliance, you have to do it adequately, where sequentially we understood the process and we need to verify also based on that, correct? Then I told you, just for an additional understanding, you also study the concept of buyback very clearly, and if by chance happens a question on how do you verify if buyback has happened, you simply have to code the provisions with the prefix verify, 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 correct? Then after that we understood about disclosures, where for each class of shares there are n number of disclosures given. All of that to validate the assertion of presentation and disclosure, we have to check properly whether every disclosure has been done properly. Along with that, if the company enters into an arrangement where they are funding to the ultimate beneficiary through an intermediary, or they are receiving money to fund it to the ultimate beneficiary, in that case also they are required to give some additional disclosures. Whether these have been done properly or not, that we have to check. For that, as per section 143(3), we also require to obtain confirmations coming from the management. Clear? So all that is with regard to audit of share capital. Clear? All right.